Well, on the couch with me this week are a colleague and partner of mine at Business Spectator, Stephen Bartholomew's, the Australian Financial Review's opinion editor, Joanne Gray, and Tom Elliott, Chief Investment Officer at Buhler Capital. Welcome, everyone.
Thanks, Alan.
Thanks, Alan.
Now, we heard Mike Smith on the subject of competition for deposits, what he's doing to and what it's doing to funding costs. Here's Gail Kelly of Westpac on the same subject.
Our retail deposits exceeded the loan growth that we did over the half, and that's important for us. And so we've seen steady progress, but we know that we have more to do there as we shift the culture of our organisation to being more of a deposit-raising culture than a lending culture.
And also, now we've got a graphic here of mortgage rates and deposit rates. Three of the four have lowered their mortgage rates by an average of 36.3 basis points, but they're all over the place on deposit rates. NAB's actually cut theirs to 3.65%, down 50 basis points, but Westpac announced on Friday that they were leaving theirs unchanged. CBA's under review. ANZ obviously still have to make their announcements next week. So it was interesting, Mike Smith talked about sound banking when he talked about deposits. Actually, we're going back to, or they seem to want to go back to, taking the money on deposits and they lend it out on loans. It's pretty old-fashioned.
I wonder if the Australian banking population is realising that what we had access to before the financial crisis was a flood of cheap overseas money, and that meant that you didn't have to worry about local deposits. All of a sudden that tap, as he said, is sometimes on, but when it's on it's expensive and then it's turned off, and we are getting back to old-fashioned banking, and it costs money.
It's happening around the globe that banks are retreating to where they came from back in the 70s and 80s, where it was traditionally the banks did fund themselves out of their customer deposits. And as Tom says, it was an aberration, that period in the lead up to the crisis.
And what Gail Kelly's been talking about is changing the culture of, I mean, it's actually quite a profound change that has to occur at all the banks, but Westpac is what she's talking about.
Yeah, and she wants, and the other banks also really, have been for years trying to get their sales staff to sell more of those sort of wealth management and savings products, and now the onus is really back on them. Productivity is going to be measured by how well they do on that front.
But what about the fact that NAB actually did cut their deposit rate by 50 basis points on Friday?
That's the penalty you pay for having the lowest home loan rate. Gail Kelly's, the strategy at Westpac's actually really interesting. They've got the most expensive home loan rate in the Westpac badge part of the bank, but they also have the highest deposit rates because they can afford it because of the home loan rate. NAB's in the other end of the spectrum, where with the lowest home loan rate, they can afford to pay less. They can't afford to pay as much.
So that's part of Gail Kelly's changing the culture. She's got high rates for both, which allows her to have that high deposit rate.
But, I mean, you could turn around the other way and say they actually do really need to attract deposits. They're a bit underfunded on the deposit front because they bought St George, which hadn't had that as a primary focus. So
I must say, I wonder why the banks don't market themselves better. At the moment, it's all about who's got the cheapest home loan rate. What about some happy-looking pensioners saying, we're getting the best deposit rate at Westpac, for example, and pointing out that, the rates going up or at least staying steady is actually very, very good for that class of banking customer.
You might also think that the Treasurer should be advocating saving rather than spending.
Well,
what do you think is going to happen now? Because we've got further rate cuts coming from the Reserve Bank. We've got a graphic here where the market has actually priced in a cut of about 75 basis points in the RBA cash rate over the next 12 months, as you can see. That's according to the futures market. So what does that mean then to the banks and the competition between them, do you think?
Well, it's going to mean more margin compression. I mean, the whole thing is when official rates are high, you've got a bit of wiggle room in terms of the difference between deposit rates or borrowing rates and lending rates. The lower official rates are, the harder it is for banks to keep that margin going. You look at the ANZ and Westpac's interim profit results. Margins are under a lot of pressure. If interest rates fall, that pressure isn't going away.
And they've still got a bunch of products that don't actually pay much interest at all. You can't go below 0% this on the transactions accounts for example.
The other element in the banking equation is volume. For 25 years they were growing at 15%. Credit was growing 15% a year every year. It's now growing at the low single digits. So there's no volume offset to this margin compression, and the margin compression is coming fundamentally from the deposits. If you look at these most recent results, about 2/3 of the contraction in margins came out of high cost for deposits, and less than 1/3 from wholesale funding costs.
So margins under pressure, continuing to be under pressure. Credit growth, not much.
Minimal.
Certainly not what it was. You've got to say the banks are looking at a tough what, 5 or 10 years, probably. Like, I mean, what Mike Smith said, it's a game changer. Life's changed completely. So, you know, they're looking at some tough times. They've had good times for a while.
I reckon if you look at the share prices of the banks, they've held up recently. Everybody's talking about yield. No one's talking about growth. I reckon the banks will become like what Telstra is, just a solid provider of fully franked dividends, not really earnings growth, at least not for the time being.
And that's likely to be the case for quite a while, don't you think?
For the foreseeable future. The economy is not going to be growing at the sort of rates that it grew pre-crisis. The amount of credit's not going to be growing at the rate it grew pre-crisis. The cost of funding is significantly higher. They've got more capital, more expensive liquidity and more liquidity. There's this confluence of circumstance which says banks aren't going to be high returning beasts any time in the next decade or so.